Hello and welcome to today's episode for Tuesday, March 25th of the Daily Trader. I'm Alex Coffey in for Kevin Hinks. Today we're going to look at two Magnificent Seven names that are doing their best to make a recovery after what has been a pretty wicked one-month slide for both of the market generals that are Apple as well as Microsoft. We're going to start with Microsoft. Reason being, we're looking at two similar strategies but slight differences between the two. And you'll see why in just a moment. What we're looking at here for an example trade in Microsoft is selling a put vertical below the market. Now, we do have earnings to contend with towards the end of April, so in order to avoid that uncertainty, I've elected for this example trade to simply just go to the April 11th weekly cycle and look at the 387.5, 382.5 put vertical. If we're able to get a $1.25 credit on this, that would be 1/4 the width of the strikes, or 25%, therefore creating in this risk-defined, profit-defined spread a 3-to-1 risk-reward profile. We'll be risking $375 theoretically, with a chance to make theoretically $125 per each one of these spreads. The break even on this elongated Z risk profile at expiration would be 386.25. So what I always say is you're sort of drawing a line in the sand, and rather than asking, despite it being a bullish strategy, you're not necessarily asking for the stock to continue higher, although you would welcome that. You're simply asking it not to go lower. So in real time, Microsoft trading in the 395 range, you got about a $9 cushion to the downside where this could still be profitable even if it doesn't move higher, in fact actually moved lower. Now, shifting gears to another name that has dominated market activity for really decades at this point is Apple. Of course, it's been under a pretty wicked slide, but trying to make a recovery. It's back over $220 a share after dipping down to the $210 range briefly in the last couple weeks. What I looked at here is taking part of what we did in Microsoft, which is the short put vertical, and then combining it with a short call vertical to create what is referred to as the short iron condor spread. So this is a neutral strategy, and for no additional buying power, you're able to add on that short call vertical, collect a little bit more credit, and create a range-bound neutral spread that is still risk-defined and profit-defined despite taking risk in both directions. So exact strikes and expirations that we're looking at here in Apple is going out to the April 25th cycle. No earnings until the early parts of May for Apple. So looking at the 210, 225 put vertical in that April 25th cycle alongside the 235, 240 call vertical, $5 wine iron condor on each side, looking to collect $1.50. Now that would be 30 cents for every $1 of risk in this trade. So creates a risk reward where you're risking $350 with a chance to make $150. You'll have two break-even points. You want it to stay in between those. Those two break-even points are 208.5 and 236.5. So it's going to encapsulate the majority of the recent trading range of the last month or so. So if it continues to trade within that fairly wide range of about $30, this one has a chance to be profitable over the next month. A little bit longer time for this one as it goes out to April 25th. You can see how you can take part of another strategy, combine it with a second strategy, and create a whole new thing here with the iron condor spread. That is a neutral strategy. So two example looks at two of the biggest players in the market, that of course being Microsoft and Apple. Thanks as always for tuning in to the Daily Trader, and we'll see you tomorrow.